FTX looked like one of the safest places in crypto. Millions of people trusted it to hold their money. Then in November 2022, the company collapsed. In just 72 hours, a crypto giant worth $32 billion was gone. But the strange part is how fast it happened, because just days before the collapse, FTX still looked stable. So what changed? The speed of the fall was unprecedented. The answer started with a single leaked document, and what it revealed triggered one of the fastest financial collapses in modern history. FTX was founded in 2019 by Sam Bankman-Fried. Most people called him SBF. He didn't look like a typical billionaire. He wore shorts, messy hair, and spoke calmly about math and risk. But in crypto, he quickly became one of the most powerful people in the industry. Before FTX, SBF ran a crypto trading firm called Alameda Research. Alameda made money by trading crypto across global markets. But SBF wanted something bigger, so he launched FTX, a new crypto exchange. An exchange is where people buy, sell, and store crypto. And within a few years, FTX became one of the biggest exchanges in the world. Millions of users trusted it with their money. But behind the exchange was a second company, and that connection would become the center of the collapse. FTX grew during the crypto boom of 2020 and 2021. Crypto prices were exploding. New investors were pouring into the market. FTX positioned itself as a professional and reliable exchange, and investors loved it. Major venture capital firms invested billions. Names like Sequoia Capital, SoftBank, and BlackRock backed the company. FTX spent huge amounts on marketing. They bought the naming rights to the Miami Heat arena, turning it into FTX Arena. They ran a Super Bowl commercial. Celebrities like Tom Brady and Larry David promoted the platform. By early 2022, FTX was valued at $32 billion. Sam Bankman-Fried became one of the richest people in crypto. He also built a reputation as the industry's responsible leader. During market crashes, he even stepped in to help struggling crypto companies. To many people, SBF looked like the adult in the room, but behind the scenes, the structure of the business had a dangerous weakness. FTX told customers their funds were safe. The exchange claimed customer deposits were kept separate. That's how most exchanges are supposed to work. But behind the scenes, there was another company closely tied to FTX, Alameda Research. Alameda was deeply connected to the exchange. Reports later revealed that Alameda had special privileges on the platform, and during the crypto crash of 2022, Alameda began losing money. Trading strategies that once worked suddenly stopped working. Losses started building, and somewhere inside the system, a dangerous decision appears to have been made. Customer money began moving. But the public had no idea until November 2022, when a leaked balance sheet surfaced online. The leak came from a crypto news outlet. They published a balance sheet connected to Alameda Research. At first glance, it looked like a normal financial document. But when analysts studied it closely, something strange appeared. A huge portion of Alameda's assets were made up of FTT tokens. FTT was a cryptocurrency created by FTX itself. That meant billions of dollars in Alameda's balance sheet depended on a token controlled by the same company. If the token price fell, those assets could collapse. And that raised a frightening question. If Alameda was this exposed, what would happen if people started withdrawing money from FTX? The crypto industry reacted immediately. And the biggest reaction came from one company, Binance. Binance was the largest crypto exchange in the world. Its CEO, Changpeng Zhao, quickly responded to the leaked report. He announced that Binance would sell its large holdings of FTT tokens. The market noticed instantly. Investors panicked, the price of FTT began falling, and then customers started withdrawing their money from FTX. Billions of dollars in withdrawal requests flooded the exchange. This is known as a bank run, when too many customers try to withdraw at the same time. And suddenly FTX couldn't process the withdrawals because the money was no longer there. In just 24 hours, customers requested around $6 billion in withdrawals. FTX didn't have the cash. The exchange froze withdrawals. Panic spread across the crypto industry. Within 3 days, the company that was once worth $32 billion was effectively insolvent. But this is where things started to go wrong in a much bigger way, because investigators soon discovered where the missing money went. Within days, FTX filed for bankruptcy. Millions of users suddenly could not access their accounts. Billions of dollars were locked inside the exchange. A new CEO was brought in to manage the bankruptcy process. His name was John Ray III. He previously handled the collapse of Enron, one of the largest corporate frauds in history. Even he was shocked. In a court filing, Ray said he had never seen such a complete failure of corporate controls. The company had almost no proper accounting systems. Important financial decisions were made through messaging apps. Some expenses were approved with emojis, and billions of dollars had moved between companies with little oversight. But the most important discovery involved the relationship between FTX and Alameda. What actually killed the company? Investigators believe FTX secretly used customer deposits to fund Alameda Research. When users deposited money into the exchange, those funds were supposed to stay safe. Instead, billions were reportedly transferred to Alameda. Alameda then used the money to make risky trading bets. When those bets lost money, the hole grew larger. To cover the losses, more funds were needed. But as long as customers kept their money on the exchange, the system stayed hidden. The moment customers tried to withdraw billions at once, the system collapsed. FTX wasn't just short on cash, it was missing billions of dollars in customer funds. The collapse triggered investigations across the world. Sam Bankman-Fried was later arrested and charged with fraud. One of the most trusted companies in crypto had turned out to be one of its biggest scandals. FTX once looked unstoppable, a $32 billion company, millions of users, powerful investors, and a founder who was treated like the future of finance. But the entire system depended on something fragile: trust. Once that trust broke, the collapse happened almost instantly. And in just 72 hours, a crypto empire disappeared. If you want to learn more about business collapses and corporate strategy, subscribe to the channel. Thanks for watching. See you in the next video.